The Bank of Canada surprised investors today, hiking its benchmark interest rate for the second time in a row to 1%. Our central bank pointed to stronger economic data in their statement, and the loonie shot up to a 2-year high. Here to walk us through the recent announcement is Demers from TD Securities. Thanks for being here.
Good morning. Thank you for having me.
So I'm going to start off with our statement this morning. About 80% of economists thought that the bank would remain on hold. What happened?
Well, it was a big surprise in the sense that nobody, I think, or few people expected the bank would hike back to back, given the April hike. But the evidence was that the economy is running on a very solid trend. GDP ran at 4.5% last quarter. So I think the Bank of Canada was more than happy to remove some stimulus and hike again.
Now, one of the things, that hawkish kind of tone that came out in the statement really sent the loonie on a tear. It was up about 1.5%, it's now around 82 cents US. What's your outlook for the Canadian dollar going forward?
Well, it's not so much the tone of the statement itself and the hike. I think that was enough to give the loonie some wings this morning. The tone itself, I think, was somewhat of a well balanced, citing some downside risk, and so. But despite that, I think despite this effort from the bank to calm down the market expectation, I think investors will be more than happy to keep on riding a stronger loonie going forward. We have both strong data and a pretty hawkish central bank.
Now, in terms of the overall outlook right now, how many more hikes do you think we could see from our central bank going forward?
Possibly one more this year. It's not impossible we get it in October if really the data just keeps surprising to the upside like it did. But a good case would be for December, and 2 more next year again. But I think there's a strong cap on that. We need the Federal Reserve to be a bit more hawkish, and right now the market does not perceive that.
And if we are in a bit of a tightening cycle going forward, we received data from the Toronto Real Estate Board this morning, found out that real estate in Toronto entered a bear market, down 20% since the high in April. What could higher rates in Canada mean for housing going forward?
But Toronto housing was a surprising, downfall after the implementation of the taxes back in April. But I think the worst is behind us, and we're finding a floor that on the downside. So although people are mentioning it's a bear market for housing, I think the upside is ahead of us. Not like we had in the past, but it's certainly more constructive. And overall, higher interest rates, mortgages will not make the housing market very strong next year. It's going to cool down nationally.
Thank you very much.
Thank you, my pleasure.